This week on Wealth Track, marching to the beat of a different drummer. While most of Wall Street has been preparing for rising interest rates and faster economic growth for years, great investor Robert Kessler has stuck to his low interest rate, slow growth theme. Kessler Investment Advisors' Robert Kessler is next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. WINTERGREEN, your home for global value. Rosalind P. Walter and the Fairhome Foundation. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. How many times in recent years have you heard money managers, financial advisors, and economists say that interest rates are about to go up and therefore advise you to shorten the maturities in your bond portfolios because long-term bonds, Treasury bonds in particular, are very sensitive to changes in interest rates. When interest rates go up, bond prices decline. When interest rates decline, bond prices go up. That sensitivity has worked mostly to bond investors' advantage over the last 30 plus years. Interest rates on 10-year U.S. Treasury notes, for instance, have declined from a high of close to 16% in 1981 to a low of 1.4% in 2012. Treasury bonds have been great investments throughout, and the yield has stayed near historic lows ever since. Well, what happens if rates start to go up? Here's a chart from Altegris Advisors showing the impact on different types of bonds if interest rates rise 1%. Prices of high-yield corporate bonds would decline about 4%. Emerging market bonds would suffer about a 6% hit. U.S. investment-grade corporate bonds would experience a 7% fall. 7 to 10-year Treasuries nearly 8%, and long-term Treasury bonds would plummet more than 16%. Ouch. Well, many pros have warned of that danger on this program for years now, including most recently Templeton Global Bond Fund's Michael Hassenstab. There has been one consistent holdout on Wealth Track over the years, who has stuck with his low interest rate theme and U.S. Treasuries. He is this week's great investor guest. Robert Kessler is the founder and CEO of Kessler Investment Advisors, a manager of fixed income portfolios specializing in U.S. Treasuries for institutions and high net worth individuals globally. For the 15 years that I've been interviewing him, he has correctly predicted that interest rates would fall, then remain low, and that U.S. Treasuries would perform well. I began the interview by asking him why interest rates have stayed subdued for so long.
Let me say that I think when we talk about so long, you're talking about a period of time from the beginning of the 80s till now. And so we consider that a very long period of time. The fact of the matter is we had very low interest rates from the early 30s until the 60s. So this is not an unusual situation. And also in global economies, free enterprise systems, capitalism, there's always this pressing for lower and lower costs and lower rates. It's the nature of a good market system, which we're in. So
and productivity and competition and all that stuff, costs go down. Right.
And there's a good and bad for that. The good part is that prices come down, and over time, generally, if you're not having a war and you're not having total fiscal irresponsibility, and in this country, we have no fiscal policy, so we're pretty good on that. So under these conditions, there really is no reason to not expect rates to continue to kind of ratchet lower. And though last year, I think when I was on the show, one of the prevalent kinds of conversations was, this is the end of the bull market in treasuries.
In bonds. And in
bonds.
Treasuries especially.
In interest rates.
Right.
And that's kind of self-serving for an industry that really, when you're looking at a stock market up 30% last year, or up 6% in the last month or so, the industry wants to see higher rates because that goes along with higher GDP. And higher GDP kind of gives you a market an equity market that really can go higher. So if you look at Wall Street and you look at the financial community, the first thing everyone's going to say is, well, things are really getting better. And by the way, when they get better, rates have to go up. And as long as I've been dealing with, or you and I have been talking, in the Treasury market, rates are always going up. I can't think of a time in the last 30 years or so that whether it's mortgage rates in the late 80s, for instance, were around 9%. If you asked anyone, what do you think about financing your house this week? We better do it now because rates are going up. Rates are always going up.
Right, as far as the investment psyche is concerned.
Sure, the real estate industry wants you to buy today because tomorrow the price will go higher.
So this is some marketing ploy?
Well, there are very sound reasons. We have, again, a marketplace of competitiveness. We have a marketplace right now in the Treasury market, we'll talk about the Treasury market, where actually the amount of Treasuries are shrinking. We had a deficit in this country of $800 or $900 billion, and now it's going to drop to $600 billion. That means we're going to issue less Treasuries.
And the Federal Reserve, however, is also owns or has been buying, 50, 60, 70% of Treasury issuance, taking Treasuries off the market.
Makes it even smaller in terms of the amount on the market. And the rest of the world looks at the United States, no matter how people may talk about it. We are the reserve currency. We are where you want to place money. And so as countries have grown, and certainly countries have grown, regardless of whether they're in a state of repression or kind of recessions, nonetheless there's more money out there. And money has to go someplace. And so a huge amount of that comes into the safest, most secure security, which is a Treasury. So there are really lots and lots of reason, not even counting the fact, which is really important, that on a relative value, Treasuries are very cheap right now. And the reason I say—
on a relative value to other markets that have sovereign debt.
That's right. We're not even a high rate compared to a number of countries in Europe and or Japan, certainly. The 10-year rate in Japan, as of today, is around 60 basis points, 0.60. We are 260. Mm-hmm. The Bund, which as a normal relationship, the German debt, our normal relationship to the Bund is about 20 basis points over that yield.
So a fifth of a percentage point.
Fifth of a percent, and that yield happens to be around 1.4. So on a normal basis, we would be around 1.6. Here we are at 2.6. And we're also in a situation where risk assets, equity markets, real estate in London, excess housing in China, all of these places have inherently tremendous risk. The Treasury is interesting because though you perceive, well, what happens if rates go up?
Right.
The fact of the matter is, no one says you have to do anything.
The natural order of things is for markets to revert to the mean, and when you've had a big rally in a market for almost 40 years, then usually there's a bottom at some point and the market will reverse, which is what people are talking about with the Treasury bond market. That it's rich, that it's expensive, that it is due for a correction, and that rates are due to come up, especially with the economy recovering and the Federal Reserve withdrawing its easing program.
Let me talk a little bit about the difference between a Treasury and interest rates, because we seem to group all of this together where people have said recently there's a bubble in the credit market. And the implication is that Treasury yields are too low,
right,
and therefore something has to happen, revert to the means, or whatever thing you want to say. The fact of the matter is there probably is a bubble in the credit market. That is, companies that we would consider risky, high yield, are at the narrowest relationship to Treasuries ever. Okay, that is probably very, very risky. It has nothing to do with the Treasury being there. The Treasury is there for one reason, because there's no demand for money in the economy. We call that velocity. So all of this money that the Fed that everyone likes to say, oh, they're printing money.
Right.
It has gone into the banking system, and what has the banking system done? Nothing. They don't lend it, it sits there. And so in an economy that has the kind of employment problems we have, and we have very serious employment problems, where student loans have averaged now, 40 million people with student loans have $30,000 or more. In 2007, people needing food assistance, that's a polite way of saying food stamps, we had 26 million. Now we have 47 million. All of these are known as consumers. And if you don't have this kind of consumption coming into the market, where's the demand going to come from?
So Robert, when I talked to you before we sat down for this TV interview, you actually said that you thought that things were significantly worse than they were a year ago. And that they are dramatically different this year than when we talked a year ago. Now, by most measures, other people would look at the economy, for instance, and how business is doing, and they would say, actually, there's been, we've had some gradual improvement. We have an energy revolution, an energy renaissance going on. We have a manufacturing renaissance. That in fact, that the economy, the U.S. economy, is in relatively good shape, and it's stable. It's not great growth, but it's okay growth. So what's dramatically changed in your mind from a year ago that the rest of us are missing?
It's worse for this reason.
And what's worse?
It's worse for this reason. We have never, in this world that we live in, seen a central bank for 28 countries reduce the rate down to a minus number.
As they have in the
ECB.
Right,
and that's
in Europe.
Europe is sitting with 12% unemployment. It's not even changing, and that's not counting Greece or Spain or countries in the peripheral area that aren't improving. If you look at China, every week that goes by, there are 3 or 4 articles in every single newspaper about the bubble in housing, in excess capacity. Excess capacity is interesting in China. We in the United States have a capacity utilization of around 79%. Not too bad.
So we're using the factories and the productive capacities at 79% of what they could produce.
China, 60%. An incredible figure. It means there's so much excess in China that whether it's housing, whether it's employment, whether it's factory utilization. So you have that on one side, China, Europe on this side. Actually, the central bank telling you it's so serious. When I was sitting with you last time, we were going through the crisis in Europe. Now they're actually recognizing the crisis in Europe. And then we have the United States, which now says, more or less, Wall Street, the financial community, we're decoupled. Decoupled means that this country can get along perfectly well without anyone. And we know that that's simply
just not true.
Untrue.
Right.
So when you ask me, is it better? Sure, it's better for segments of the U.S. population. It's not better for the housing industry, which looks like it's turning down, not up any longer. And if you look at employment in housing, we've lost 1,600,000 jobs over the last 5 years, and we're not getting them back. Those are good paying jobs. Where have they gone? We've actually brought it into healthcare and areas like which are lower paying jobs. So is it really getting better? But Silicon Valley certainly is getting better, and certainly the stock market is up. But that belies the point that a vast majority of Americans are not getting higher wages, they're getting lower wages. The CPI that came out, an interesting number, because everyone went a little bit bonkers over a higher CPI.
Right.
The Federal Reserve said, well, it's a little noise. I would suggest the PCE, which is what the Federal Reserve watches, another inflation gauge, is at 1.5%, really hasn't moved. I think people are taking a greater, I'm not suggesting people shouldn't own stocks, I've never done that, equities. But they're taking a greater and greater risk in a marketplace after 4 or 5 years where everyone acknowledges this is the weakest recovery in history. But don't worry, things are getting better. And I would suggest my job isn't to come on and sell something. I mean, we in the Treasury business, we can be long or short from our fund, and That's a trading mechanism.
Right, and so talk about that, because you have been, even though you are a long-term Treasury bull at Kessler Investment Advisors, you certainly have, depending on what's going on in the markets, you've certainly shorted Treasuries on.
And I don't recommend anyone do what we do. I mean, we do it on a professional basis. The purpose of a Treasury shouldn't be misunderstood to be a trading mechanism, a trading vehicle. The purpose of a Treasury is to know that money will be there and that you'll get a certain return from it. Believe me, there's nothing wrong with 2.6% when money market in Europe is paying minus 0.10, or in the United States paying 0.
But it certainly is if you're thinking out 10 years, because again, historically, and correct me if I'm wrong, normally we do have inflationary periods and interest rates do go up and down. So if you're dealing with, your purchasing power, 2.6% a year over 10 years seems like a very low rate of return compared to what we've had in recent history, at any rate, at least in the last 30 years.
And you're suggesting that over the next 10 years something very positive is going to happen, meaning that prices are going up, wages will start going up.
That's the optimist.
Yeah, without wages going up,
right,
believe me, there's no consumption. I would suggest to you that this deleveraging process, the mess we got into in 2007-8, the consumer, the household, that got into this high amount of debt, is in the middle of the process of bringing it back down so that there can be consumption. You can't have...
So 6 years in, we're kind of midway.
I mean, it could be 4 more years, it could be 7 more years. I don't have a clue.
Right.
But I do know one thing. The risk during that period of time is enormous. And when you step into a market like the equity market, one of the things that you hear, it's cute, it's a Wall Street thing. Listen, had you not bought equities over the last 4 or 5 years, you missed out on one of the great rallies in the world. Thank you very much, but you forgot to tell me about had I been there in 2002 and 3 and lost half my money in 2007 and 8. You just kind of conveniently forgot that part.
Right, as if we all came in at the bottom.
Yeah, we all came in at the bottom, which we never do. I certainly don't. I'm not that smart, and we probably don't do that. So the risk isn't that you put all your money. I mean, I've heard recently, and we all hear it, no, I'd put even more money in equities. What do you think of that? And the answer to that is, when you start hearing that talk, don't do it. It's reasonable to be careful, and I'm only suggesting that the Treasury market, and I'm not even suggesting the general credit market any longer.
So you're not suggesting the general credit market. So when you compared Treasuries, for instance, to high-yield bonds, so looking at other debt instruments.
For 1.5% more, or 0.5%, why are you doing this?
You mean taking that kind of risk?
Taking that extra risk for that, and the risk is enormous. Because we know for sure that the Treasury will pay off. We know that the worst that can happen, if you have a 10-year Treasury, is you have to stick around for 10 years. It's possible that Robert Kessler is right, rates actually go down substantially from here.
And that is basically your prediction, is that you think that rates will go down substantially from here. Of course, from 2.5%, substantially can be
I don't see any logical
half a percentage point or something.
I don't see any logical reason that your European rates, that we're competing with the Spanish and the Greek and the Italian rates, and they're virtually even with the U.S. rates.
So whose credit would you rather?
Whose credit would you rather have, and why should we be so different than the German rate? We are the reserve currency. So if you say, well, I don't know, I think things will settle down, you talk about reverting to the mean, reverting which mean? There's no particular reason why you can't see rates at 1.5%, considering that rates are 0. You get 0 for rates right here. As to whether the Fed is going to raise rates, which of course Wall Street would always like you to believe, well, the Fed is always going to raise rates. There's never a time, other than when the market crashes, that Wall Street agrees rates are coming down. Other than that, rates are always going up. And so my guess is the Fed is correct. They're not terribly correct on prognosticating where the GDP is, and there's a reason for that. They are the head banker. What are they going to tell you? Things are not good? They always tell you things are going to be better. And in fact, it tends to be, in the last 3 or 4 years, wrong. So probably we'll kind of muddle along. Hopefully we'll keep doing 1 to 2%, and that's probably what we'll do. Rates will stay at 0, and how long will that be? If we don't get into trouble. If China doesn't kind of have a hard landing, which is perfect, plausible. If Europe doesn't get into more of a mess than they're in already, if the United States doesn't turn down, because housing certainly doesn't look like it's going up anymore. So in this fragile global world we live in, we are not decoupled, we are part of this whole thing, and I would just suggest that the Treasury market is very attractive.
Rates of return that you get in the stock market, however, over time, and if you're talking about reinvesting dividends, for instance, and there are many companies that have dividend streams that are growing, and if you reinvest them, they are, they're basically keep up with inflation.
So let me debunk this.
All right. That's the argument as to why should I settle for 2.6% when I can get growing dividends and reinvest them?
If you take 2000 to today, so we just kind of ran numbers. If you had let's take a zero coupon treasury, a long-term treasury, you'd be making an annualized return of around 15%. That's 14 years, annualized return.
Right, which is incredible. It's
great.
The
equity market, had you done the same thing, 3.5%, dividends reinvested, not impressive. Okay. For the last 4 or 5 years, which is the years that we all want to really get crazy about, the equity market would have brought you 22% annually. Fantastic. And that same bond market, if you only took that period of time, which is not great, you made around 10.
Annualized.
10 annualized. Right. So I give you 15 and 10, and it's not an equity. An equity has what's known as a downside to it. It is this unlimited period of time on a call. It's not 10 years, it's not 5 years, it's not 30, it's unlimited.
Right, if you hold a bond to maturity, however, you know you're going to get, and so that's your point, is to hold it to maturity.
Well, or not. And we're talking about just rolling treasuries over this period of time. If I take it from 1980, it's going to look the same way. There's a mystique, a seductive kind of a question with equities, and we all love it. I mean, there's nothing that's better than buying an equity when it goes up.
So
it's when it goes down.
One investment.
And I'm not knocking equities, believe me.
One investment for a long-term diversified portfolio. What would you have us all own some of?
Buy a long-term zero coupon bond. I mean it more than I meant last year. It wasn't so terrible this year. Rates right now on the long-term market are roughly 3.5%. If it goes down to 3, which I would expect, frankly, by the end of the year, that's a good call, particularly the end of the year, that would be about a 11-12% return. That's not a big deal because long-term treasuries were at 2.5% going back a year or so ago. If it doesn't go down, part of your portfolio will be getting 3.5%. And if you're a long-term player, which everyone says about the equity market, thank you, we're buying it for the long, although when everyone tells you we're buying it for the long term, it means they're not making any money. But they're buying it for the long term, then you need to buy treasuries and think of it as a part of your portfolio. I'm not suggesting it's your whole portfolio, it's part of your, and the reason I think you don't hear that enough is because if you suggest that, you're also suggesting rates will stay low. And rates staying low means GDP stays low. It means equities are not earning as much money as we're being told. And so you never sell treasuries.
Robert Kessler, always a treat to have you, and we will have you back at the same time next year to see if you are right again, 10 years later.
Thank you very, very much, and it's my pleasure being here. Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is ignore the crowd and own some U.S. Treasury bills, notes, or bonds for their liquidity and security. There are multiple geopolitical hotspots in the world right now shaking investor confidence. There are economic challenges in many parts of the globe as well, and the U.S. stock market is trading at or near record levels. U.S. Treasuries are the investment of choice in times of uncertainty and trouble, and having some Treasuries in your portfolio can provide some insurance and stability. I hope you can join us next week. We're going to sit down with another contrarian, this time in the stock world. Veteran investor Steve Luthold explains why he is investing in nuclear energy and China in his new firm, Luthold Strategies. In the meantime, to see more of our interview with Robert Kessler, check out Extra on our website. We will also discuss the role of prenups in the WealthTrack Women's section of our website. Have a great 4th of July weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. WINTERGREEN, your home for global value. Rosalind P. Walter and the Fair Home Foundation.